Hi, this is Charting Man Dan of TheChartGuys.com, home of technical analysis education. Click the link for a free week trial, no credit card required, and gain access to our multiple live broadcasts daily, community chat room, educational videos, nightly watch lists, and more. Invest in your education and future and join the community today.
Hey everyone, Charting Man Dan here of TheChartGuys.com doing an August trade review. This is the trade tracker of TheChartGuys.com and something we share with members. Just want to have some accountability and transparency of the trades that I'm in, the times of entries and exits so people can go back and review. And we also have a bunch of members that are contributing as well. So a nice place to have a reference point of what went on during the month. So by no means is this video boasting any gains. I'm trading with small amounts here and I'm not in it to make money right now. If I were wanting to trade and trying to make maximum returns, I would not be leading a chat room and answering hundreds of questions a day. I would just be a member in the chat room just like everybody else. But that's besides the point. Going to go over some review here on the month, and then at the second half of this video we're going to get into specifics, looking at what I want to point out is the 20-period moving average on the 5-minute chart, how useful that moving average can be. So we're going to look at some examples over this past week, and then I'll wrap it up with a trade on Friday trying to get into the miners bullish, and I ended up being stopped out, so some lessons learned there as well. So over the month of August, I went 24 for 43. I disregard anything that's under $100 either direction, and that's 56% for 2,900. So you look at that and you say an all right month, and again, I'm trading with small amounts. Any options, I'm trading between $1,000 and $2,000 for my position. And why I was disappointed with the way my month went is because I started really, really hot. I started 11 for 14 and up 2,500, and that was in the first week of August, essentially. So very hot start. And then from there, essentially, I had 30 trades where I made another $400. So certainly didn't keep that pace up. I had that funeral break that I went on. Certainly not going to be making excuses, but anytime that you are out of your element in terms of the normal routine, I have my normal routine every morning that I do to prepare for the day. And for a week there where I was attending a funeral, I was trading in a Starbucks and running the chat room, and certainly not comfortable and in my element. And that's when the losing trades started to tally up here and had to work to get those back towards the end of the month. That's why I went almost break even. So the important thing of reviewing your trades, I highly suggest it every trade that you make, and it doesn't have to be every single trade, but start to notice the patterns. No matter how good a trader you are, you're always looking for ways to improve. For me personally, I love day trading. I love being cash at the end of the day. So I'm working on my patience, working on practicing some swing trading and seeing how that goes. And the lesson that I'm learning there is my biggest losses this month were when I was swing trading, and that's because my stop losses obviously do not trigger overnight. And if I'm in an options position and let's say Netflix was downgraded overnight and it take a big hit there. So what I learned is that when I'm swing trading, my stop losses do not trigger and my losses are bigger than I would ever let them get day trading. My stop losses would have triggered long ago, and some of these losses here, negative 485, negative 450. I usually try and keep my losses between $200 and $300 at most. So that's something that I have to work on and try and practice swing trading with patience. And even if you're the best trader in the world, you're looking at different indicators, playing around. Maybe you want to add the ADX and DMI indicator or the Williams percent, whatever it may be, trying to use different indicators and see if they can improve your trading. It's always about constantly evolving, and we know the market is always evolving, so we need to be doing the same to keep up with it. So let's now go into a little bit of review in terms of specifics. Let's check out SPY. There were some examples pretty much the end of the week, Wednesday, Thursday, Friday, the 20-period moving average support on the 5-minute. And I've said in some of my videos over this weekend, so it might be repeating for you, but if I had to take everything off the chart and I could only keep one thing besides the price action, it would be the 20-period moving average. So here's the 5-minute for SPY on Wednesday. Started as resistance, rejected 5 times, pullback, rejected, rejected. So if you're playing bearish and your guideline is I'm going to stick with SPY bearish today until the 20-period moving average becomes support, you're in this trade making really nice gains for 3.5 hours, 4 hours, and you know to exit once that 20-period moving average becomes support. If you're happy with the day, you stop trading right then and there, or you flip to going bullish. And if you flip to going bullish right when that 20-period becomes support, it held the back test right away, and then it continued bullish for the rest of the day. So big gains in both direction using the 20-period moving average. And if you were trading weekly SPY calls, weekly SPY puts, and then flipped over to calls, you had a really nice day on Wednesday just using the 20-period moving average. Let's see how that worked on Thursday. Same scenario setup. Started as resistance, rejected, back test and failed, and you just made really nice money on a big dump right out of the gate. And if you wanted to see potentially further gains, you exit when the 20-period moving average becomes support. You enter when the back test holds that support. Rocket ship for 25 minutes for the bulls. Big gains both directions dictated by the 20-period moving average support. And to top it off, Friday, similar thing, except the opposite. We started with it as support after the data was released, pre-market, bullish reaction, pulled back, bounced off of it, signal to get in when the bears knock it down and we lose that support. Then you're in a bearish trade for 3 hours and you're not exiting because the 20-period moving average is still resistance. Then it becomes support, bullish for the rest of the day. So 3 days in a row on SPY where the 20-period moving average alone dictates your entries and exits for potentially SPY calls or however you want to play it, and giving some really nice trades using that moving average alone. So another example, let's look at Tesla on Friday. Tesla was dumping and the bears were in full control, and we knew the bears were in full control the whole day because the 20-period moving average could not be gained as support. So rejected 3 times in the first 45 minutes of trading, bounce attempt, rejection, rejection, another 4 times. So if you're in bearish and you're saying to yourself, okay, I will exit Tesla bearish once the 20-period moving average becomes support, you were in this trade the majority of the day making big gains. And then you could say, I'll go bullish when the 20-period does become support finally. And there were some small gains to be had there, no big move to the upside, but definitely some clear signals, close above the 20-period, big time follow through the next 10 minutes. So the 20-period moving average, cannot stress it enough. It should be, let's say your trading game plan is a dinner plate. The 20-period moving average is your meat and potatoes. Bad example, but you know what I mean. So let's go for another example here. Apple, Friday. And again, you can see that I'm taking all of these examples from pretty much the end of the week, the last 3 days. So you can imagine if I were really digging back here in history, I could find hundreds and hundreds of examples on whatever stock you're looking at, the 5-minute chart, 20-period moving average. So Apple starts the day bullish, bounce off the 20-period support. Again, we see the range tightening. We know, okay, we lose that 20-period, things are going to shift bearish. We lose it, back test, reject from that level, lower highs, lower lows, you're in that bearish trade for another 2.5 hours. And then you flip to going bullish when it becomes support, and then you got a bullish trade for over 2 hours. Same thing. So let's now look at an example of the miners on Friday, where I personally had a bit of a frustrating stop out. And the number one reason people say they don't want to use stop losses is because they say, oh, it always stops me out and then turns right around and runs to the upside. And that may be true, but in my opinion, that is nowhere near enough of an excuse to not use stop losses. That just means you need to work on stop losses. Just like I said at the beginning of this video, that can be something that you need to practice, and you can do it paper trading or however you want, but maybe giving some more wiggle room, maybe scaling into positions rather than getting them all at once. And that's my lesson that I learned on Friday. So you always need to have a stop loss. These miners, the dump that we had over the past week, so many people were stuck in these miners because they did not use stop losses, and every day they felt more and more sick to their stomach. And it's just a lesson in stop losses. Anytime someone has a big loss in the stock market, number one thing to respond to them is use stop losses on every single trade and prevent that from happening, prevent from getting trapped, prevent that sickening feeling in your stomach. So for JNUG, we had the bullish reaction to gold on the data Friday morning. We knew the bulls made a bullish break on that gold chart, and we saw consolidation for a significant portion after that, about a couple hours. So I knew going into the morning, I want to enter miners bullish, but I want to make sure consolidation is done, and I want to get a nice timed entry. So I was using the 20-period moving average support, and I got a little premature. I jumped the gun, so to speak, and it was because we had our low, a little bounce attempt rejected, and a higher low. After that higher low, that's when I started paying attention right here and said, okay, I want to get in, and I'll put my stop loss if we continue to set lower lows. And in hindsight, if I had just waited until the 20-period moving average became support, I would have had a really nice trade for the rest of the day. So I ended up purchasing a 1,000 share position probably right around these candlesticks right here after that higher low was set, and ended up being up maybe $200, $300 on this little move to the 20 period moving average resistance. And at that point, I had set my stop loss to break even, because when I'm up 200 to 300, I figure, okay, worst case scenario, now that I have these gains, I want to not face any losses, essentially. So I put my stop loss in at break even. This candlestick here stopped me out, and then it pulled back all the way down to 1934. So I would have ended up being down 200. Now that I'm recalling, my entry was 1954. So I would have been down 200 had I not had a stop loss in or had bigger wiggle room. And then, of course, the bull showed up and left over 1,500 on the table. Had I held that 1954 position to the end of the day, that would have been worth essentially $1,900 at the top. So that was a big gain left on the table. And the lesson I learned, number one, be patient, wait for that 20 period moving average to become support, and I wouldn't have risked a stop out. And number two, I could have scaled into the position. Because I entered 1,000 shares right out of the gate, that means that I don't have much wiggle room before I'm losing hundreds of dollars, just a few ticks in the price. And as if anybody following the miners knows, they are certainly very volatile. So had I entered maybe a 500 share position, and if I wanted to risk maybe a 200, 250 stop loss at the most, that would be the most I lost. Let's say $200. So I'm in at 1954 with a 500 share position. That means I can give 40 cents of wiggle room before I hit a $200 loss. So let's say I entered 1954, 500 shares, put my stop loss at 1914. I would not have been triggered out here. And then once we saw a continuation to the upside, I could have added and doubled my position. I am all for adding to positions when the trade is working for you. I am not for averaging down. If you're averaging down, that means the trade is not going in your direction, and you likely should have been stopped out by now. But if the trade is going in your direction, adding while you're already profitable, nothing wrong with that, as long as your stop loss is still in place, and that would have benefited me. So multiple lessons learned on that stop out to end the week, and technically that was in September, but we're going to call this the August trade review. So that wraps that up. Hopefully you gained some insight. I appreciate you watching. Come on into the chat room and hang out with us for a free week. See if you like what goes on. I certainly am very proud of the community and all the members' contributions. Great group of people. Have a wonderful long weekend.